All right. Well, thank you, everyone. Good evening. I would like to say thank you for attending our part two of our three-part Tackling Taxes, the 2024 tax season. This webinar is brought to you from Brooklyn Legal Services Corporation A, or Brooklyn A's Consumer Economic Advocacy Program, and the team at Grow Brooklyn, who you will hear from shortly. My name is Kendra Dunstan. I'm the Development and External Affairs Coordinator here at Brooklyn A, and I will be your moderator tonight. Brooklyn A believes all New Yorkers should have equal access to legal services to seek justice, make their voices heard, and overcome systemic racism and oppression. We were established in 1968 as part of the War on Poverty, and Brooklyn A believes attorneys have a critical role to play in combating poverty, inequity, and racism. Our civil legal services, organizing efforts, and educational resources assist our clients and their communities in defending and mobilizing against harassment, displacement, and gentrification and asserting their rights. Tonight's program is brought to you from our Consumer Economic Advocacy Program, or CEA, and here they prevent foreclosures and defend against predatory lending. They resolve tax issues with the IRS for low-income taxpayers and strive to ensure that vulnerable groups have strong safeguards in place to help them build and maintain assets throughout their financial lives. Additionally, under the CEA program, we have a domestic violence unit that offers assistance with orders of protection, child support, custody, and more. We have two other practice areas that you can see on the screen here, and they're for our renters, and we help prevent against evictions and harassment and fair housing claims, repairs, and tenant organizing. And then we also have small business services where we assist with commercial lease matters, and we give advice on laws and options. And we also help with nonprofit and corporation and startup services and more. I would like to thank our sponsors of this three-part series, Senator Roxanne Prasad, Councilmember Crystal Hudson, and Councilmember Sandy Nurse. Councilmember Sandy Nurse is tonight's sponsors for this particular webinar, and she represents the 37th Council District, which includes neighborhoods of Bushwick, Brownsville, Cypress Hills, City Line, and East New York. She currently serves as the chair of the Committee on Criminal Justice and was formerly chair of the Committee on Sanitation and Solid Waste Management. Councilmember's nurse priorities are improving the health and well-being of the communities that she serves. She's focused on housing for all, high-quality public education, increasing public safety, and fighting for a livable, sustainable, and resilient New York City. Tonight, we have Dom Alexandri, the Director of Outreach and Events, here to give us an address from the council member. Dom, I just want to say thank you so much for taking time out of your busy schedule and just being here to support your constituents. I'll turn it over to you.
Thank you for that, Kendra. Truly appreciate you. That was a phenomenal introduction. I'm gonna need a copy of that. I want to say good evening to everyone. I'm Dom Alexander. I'm the Director of Outreach and Events for District 37, which covers Bushwick, East New York, and a bit of Brownsville. I want to thank you all for joining us for this important conversation of tackling taxes. Unfortunately, the council member couldn't be here due to other commitments, but I'm honored to share a few words on their behalf. Tax season can be stressful, but we're here to make sure you have the resources and the support you need. That's why I want to remind everyone that at our office, we have Tax Prep Fridays happening now till April. We've partnered once again with Urban Upbound to provide free tax prep services for District 37 residents right in our office every Friday from now to April 11th. And whether you live in our district or not, our office is here to help. If you have any issues or need assistance navigating city agencies, don't hesitate to reach out. We have a great team and we get things done. I'll drop my info in the comments and feel free to hit us up. I want to say thanks again for being here and let's get into it.
Dom, thank you so much. I appreciate it and appreciate the resource. We definitely are going to share that information out. And just, your office is, one of our staunchest allies where you are constantly working with us and fighting hard and supporting everything that we do. We appreciate you and your work so much. And thank you again for being here tonight. Look forward to working with you. All right. So tonight, our presenters, we have Charles Healy, and he's our senior staff attorney in the Consumer Economic Advocacy Unit. Charles Healy is a graduate of Brooklyn Law School and the Ohio State University. He's admitted to practice law in the state of New York, and he's also admitted to practice in U.S. District Court in the Southern Eastern Districts of New York, as well as in U.S. Tax Court. And from Grow Brooklyn, we have Jason Weeks, who is the tax site manager, and he works to serve and ensure that thousands of Brooklyn families are protected and protect millions of dollars in financial assets each year. So with that, I'm just about ready to turn it over to Jason to get this program started. I do want to let you know that we will have a Q&A at the end of the program. You will have options to type your questions in the chat and I will read them out as we go, or you can raise your hand and you can ask the experts directly. And for the folks on Facebook Live, drop your questions in the chat and we will get back to you. And we will try to answer as many questions as possible. And if we cannot get to your questions, we will leave an email that you can email us your anything that you need to know, and we'll get back to you and get you to the information you need. So now with that, I can turn this over to Jason.
Hello, everyone. I'm Jason. I'm from Grow Brooklyn. I'm a senior tax manager over at the Grow. And so I'm going through basically.
I'm sorry, Jason. You're breaking up on my end a little bit.
Out and what it does. So Grow Brooklyn and their other programs basically
Hi, Jason. Can you hear me?
Yeah, I can hear you now.
Okay.
Is it good now?
It sounds very strong now. Yes.
Okay, perfect. Okay, so I'll repeat what I was saying. So, I'm Jason Weeks. I'm a senior tax associate at site manager for Grow Brooklyn. I'll be talking a little bit about what Grow Brooklyn does, especially with the free tax sites and with dealing with the provider program. You can go to the next slide. Okay, so basically this this slide is just talking about how you can book your free appointments through the prep tax. This is with Senator Prasad's office basically. So this is the free preps by phone is Tuesday to Friday, 12 p.m. to 8 p.m. and Saturdays, 12 p.m. to 4 p.m. The additional information will be basically will tell you, for single filers with income up to 65,000, filing with dependents with incomes up to 93,000, self-employment filers up to 35,000. We have a special program for the self-employed taxpayers with up to $250,000 in expenses as well. Next slide. Now we'll be talking about tax credits and deductions. Claiming tax deductions. A tax deduction is a dollar amount the IRS allows taxpayers to subtract from their adjusted gross income to lower their taxable income. Next. Deductions. There's a standard or itemized deductions. A standard deductions for most taxpayers is the set dollar amount based on the taxpayer's filing status. As an increased standard deduction is available to taxpayers who are 65 or older or blind. Dependents. If you can be claimed as a dependent, you can still be eligible for a standard deduction. Taxpayers not eligible for the standard deductions, married filing separate if their other spouses itemized. Married taxpayers who qualify to file as head of household may claim the standard deduction even though their spouse filed a married filing separate and itemized. Since 2022, those who have taken standard deductions may not take the above-the-line deduction from charitable donations on line 12B has been eliminated. So deductions basically, this is what your filing status would be. So if you're single and if you're single under 65, your standard deduction is 14,600. If you're single 65 or older, your standard deduction is 16,550. If you're a head of household under 65, your standard deduction is 21,900. If you're 65 or older and head of household, your standard deduction is 23,850. Married filing jointly under 65, both spouses, is 29,200. Married filing jointly 65 or older, one spouse, 30,750. If married filing jointly 65 or older, both spouses, 32,300. Married filing separately, any age, $5. Qualifying surviving spouse under 65, 29,200. And qualifying surviving spouse 65 or older, 30,750. Itemized deductions. Itemized deductions include unreimbursed medical and dental expenses, including prescription drugs, health insurance premiums, including premium deducted from your Social Security income, transportation, 18 cents per mile driven during January to June, and 22 cents for miles driven from July to December. Long-term care premiums for taxpayer spouse and dependents, only that portion that exceeds 7.5% of your AGI. State and local taxes, real estate tax paid limited to max 10,000, married filing separate 5,000. Mortgage interest from 1098, health and equity loan interest paid in deduction in the loans was used to buy or build or make substantial improvements on the residence. Next. More itemized deductions. Points only. Points paid as form of interest can be deducted on your Schedule A. General points must be spread over the lifetime of the mortgage. However, if the loan is used to buy or build taxpayer's main home, the taxpayer may be able to deduct the entire amount in the year paid. Gifts and charity in cash of any kind. Next slide. Gambling losses to the extent of winnings. Casualties and theft of loss from a federal declared disaster, Form 4684. Refundable versus non-refundable. Both types of credits offer you the chance to lower the amount of your taxes you owe. Refundable tax credits can also be, you can get a tax refund when you don't owe any taxes. Some taxpayers might find the non-refundable credits, deductions, or other circumstances leave them with a zero tax due. Even with no taxes owed, taxpayers can still apply and refundable credits that qualify for and receive the amount of the credit or credits as a refund. Consideration: the taxpayer ends up with a no taxables due and no taxes due, and the taxpayer qualifies for a $2,000 refundable tax credit. The taxpayer could receive the entire $2,000 as a refund. Refundable tax credits are called refundable because if you qualify for a refundable tax credit and the amount of the credit is larger than the tax you owe, you will receive a refund for the difference. If you owe $800 in taxes and qualify for a $1,000 refundable credit, you would receive $200 in refund. What is a tax credit? Tax credits reduce your actual tax liability. Some common credits are earned income credit, child tax credit, child independent care credit, education credits. All tax credits come with a set of qualifications that the taxpayers needs to meet in order to receive the credit. Some common requirements include all income level within a certain range, family size, or a requirement that the taxpayers had some sort of earned income. Tax credits reduce your actual tax liability. earned income tax credits. The EITC earned income tax credit is a refundable credit designed to help out low and middle income households. To qualify for the credit in the 2024 tax year, a single filer with no children must have an AGI below $18,591, while the cap for a married couple with 3 or more children is $66,819. Earned income tax credit, refundable credits designed to help low to moderate income households. I said that already. That was done. You cannot claim the EITC if you have investment income over $11,000 or if you're married filing separately. Depending on your income, your filing status, and number of dependents, the credit can save you anywhere from a few hundred to a few $1,000s on your taxes. The earned income tax credit is an important benefit for working people with low to moderate income, but you must file a federal tax return to get it, even if you owe no income taxes. So this is basically the chart that can basically tell you what you how you can get your earned income credit. So children or relatives claimed 0, filing status head of household, married, filing separately, or widowed, $18,591. Filing as married, filing jointly is $25,511. This is with no children, no dependents, basically, no children. With one child is $49,084, and married filing jointly is $56,004. With 2 children, this will be 50, or 2 dependents, basically. It could be a child, nephew, brother, sister. It's $55,768. This is the max that you can make, actually. And for married filings jointly is $62,688. 3 children is $59,899, and married filing $66,819.
Jason, just a quick question. So if I am single with no children,
Yes.
and I make more than $18,591, I will not be eligible for the earned income tax credit?
Exactly.
Got it. Thank you.
No problem. Next, type of maximum EITC credit amounts. Dependents, if you have no dependents, the max credit is $632. 1 dependent is $4,213. 2 dependents is $6,960. 3 or more dependents is $7,830, and that's actually the max credit you can get. So, for instance, the earned income credit goes as a slope. Basically, it goes like a roller coaster. So the least you make, the least you'll get back, and then it slopes up, and then you peak at a certain point. For instance, for like you said, the $18,891, you're probably going to peak at, I want to say, like $8,000. That's with no children. You'll peak and get the max probably at that amount, at the $632. But then after, when it goes up and up and up, it goes down, down, down until it zeroes out again. And it goes with dependents, with 1 dependent, 2 dependent, 3 dependents, same thing. Next, tax credits advice. Why file? About 1 of 5 eligible taxpayers either don't claim some credits on their tax returns and don't file a tax return at all. Even if individuals are not required to file a tax return, they should file to qualify for certain refunds. To get your EITC, if the taxpayer has earned income and qualifies for EITC, to get additional child tax credit or the American Opportunity Credit, to get back tax withheld. If you have to pay back excess premium tax credits, additional tax credit Schedule 2, Line 2, or claim net premium tax credits, additional credits Schedule 3, Line 9, under Unaffordable Care Act, must have a 1095-A. If the federal return is required, they may benefit by filing the state return. Child tax credit. The child tax credit, in brackets CTC, lets your credit up to $2,000 per dependent child under the age of 17. The income limit is $400,000 for married filing jointly and $200,000 for all others. Ooh, I didn't know it was that high now. The child tax credit is also partially refundable up to $1,500. Child tax credit is a non-refundable credit for tax year 2024. Families claiming children a child tax credit will receive up to $2,000 per qualifying child. Eligibility: under age 17 of December 31 and of the tax year, U.S. citizen, natural or resident of the United States, dependent on the taxpayer, child, sibling, or descendant of either. Relationship criteria: provided less than 50% of their own support, live with the taxpayer for more than half of the year, must have a social security number, special rules due for divorce and separate parents. Child independent care: you can claim the child tax, the credit, even if you work from home and pay someone to care for your child. Have the care provider's name, address, and ID number if the taxpayer tried to obtain this and could not claim the credit. However, non-EFAL and may be disallowed. The credit ranges from 20% to 35% of the taxpayer's expenses. The percentage is based on the taxpayer's earned income and adjusted gross income. The amount of the credit cannot be more than the amount of the income tax on the return. It can reduce the individual's tax liability to zero, but it will not give the taxpayer a refund. Payments to relatives may qualify as a work-related expense if the taxpayer does not claim the relative as a dependent. Not allowed if the taxpayer's child who is under the age 19 and the end of the year, even if the child is not the taxpayer's dependent. If you are a college student and the student's parents are graduate with a student loan debt or an employee seeking further education in your field, you cannot qualify for one. You can qualify for one of the key tax breaks. The American Opportunity Credit, good for 4 years of undergrad higher education, can pay up to $2,500 for qualifying expenses for each qualifying student. Up to $1,000 of that is a refundable. The Lifetime Learning Credit, worth up to $2,000 per year, but is non-refundable per tax return, not per student. Can be used for undergraduate expenses, graduate school, even professional or vocational courses. The student's loan interest deduction helps cover the interest you pay on your student loan, can reduce your taxable income up to $2,500, and you can claim it even if you don't itemize deductions. Not available if you are married and filing separate. Planning for college yourself or for your child: the 529 plan, an education savings plan operated either by an educator institute or by the state. There are two types. The savings program, where a enter account can be used at any according college, university, or other schools. A prepaid plan, where the state tuition is paid up to front individual internally. This type of plan can set you up with a particular college or university in mind. Covered Dell Education Savings Account. The account let you set aside up to $2,000 per year in beneficiary and can be used tax-free, not only for college, but for K through 12 expenses as well. The student beneficiary must be under age 18 when the account is created. There are some limitations. You can say, because it's usually the financial institution where the account is located. Sorry, I can't see that part. The consider a parent's asset by the financial aid system listed in the 529 savings plan. Thanks. IRS tax dates, and to remember, tax deadlines. The deadline for filing for most Americans is Tuesday, April 15th, 2025. When the deadline is up to file an extension, taxpayers requesting an extension will have up to October 15th to file their 2024 tax return. Filing an extension does not push back your payment deadline, though. You still need to submit anything you owe on time to avoid late penalties. An extension must be given to you more. It gives you more time to complete your return, but you must file by the late tax deadline in any case. In this case, tax-related theft recap. Who is a personal identification information? Personal identification information is any information that can be used to authenticate your identity. This includes social security number, passwords, tax ID number, credit or debit card numbers, date of birth, prior year AGI, and so on. You can never be too careful about your PII. Make sure that the website you share your PII or social secure measures in place, like two-step verification and encryption certifications. Phishing and how to avoid it. Phishing is a tactic used by scammers to gain your personal information online. Scammers can use your emails or websites to lure victims into giving up personal information by posing as a friend, organization, a government agency. That goal is to nab any form of personal identification information. The IRS will never email you. If you ever receive an email claiming to be an IRS that detains the PII, you can confidentially ignore it. I think targets of abuse and claim independence.
Yes, Jason, thank you so much. I'm just going to pause for one moment and see if we have any questions in the chat. Or if you have a question right now about anything that Jason covered, feel free to raise your hand and I can unmute you. And if not, we can continue. Oh, we do. Tafari.
Pleasant good evening.
Good evening, Tafari. Thank you so much. What is the question you would like to ask?
Do you guys also help with if you have like the back taxes? You have a small business, you did miss like a year prior. Am I still able to come in for some advice, some help?
Basically, so if you have back taxes, it depends on if it is it a self proprietorship or is it an LLC or S corp?
LLC, that wasn't, yeah, LLC.
It is an LLC, yes. Well, if you call the Grow Brooklyn hotline, there's specific people that actually deal with LLCs, basically. And back here is, of course, it's late because you need to file every year, especially for corporations. But yeah, they'll be able to help you with the back years for the LLC. Because for LLCs, you still have to, even if you made no profit, you still have to file them.
Yes, absolutely. Thank you so much.
No problem.
Thank you. Okay, we are going back now. Can you see my screen, Charles?
Yes.
All right, it's on here.
Hi, my name is Charles Healy. I'm a staff attorney with Brooklyn Legal Services Corporation A. First, I want to thank Senator Roxanne Prasad, Council Member Sandy Nurse, and Council Member Crystal Hudson for hosting and sponsoring this event. And also thank you to Grow Brooklyn and Mr. Weeks for presenting today. And we're all glad that you're able to join us to learn more about preparing your taxes and deal with some of the issues that you may be facing in connection with your taxes. So today, what I'm going to talk about is a few different subjects. The first is I'm going to talk about dependents and how those are defined. Mr. Weeks spoke about dependents and some of the credits that are connected to having dependents on your tax return. So I'm going to go into a little bit more detail about how you know if someone can be claimed as your dependent, to just clarify some confusion there might be on that, and talk about tiebreaker rules, which are rules that determine who can claim a dependent if there's more than one taxpayer that would like to do so for the same dependent on a return. I'll talk about identity protection and identity theft, which Mr. Weeks also just spoke about. I'll speak about something called innocent spouse relief. We'll talk about anticipating audits that you may receive from the IRS or New York State, and some additional tips in connection with your tax returns. After that, we'll take your questions, but for now, we can go to the next slide. Okay, so dependents are a subject where we hear often about dependents and having those on your return, but there is sometimes confusion about who is actually can be considered a dependent. So I want to see if we can, or I'm going to talk about that today and hopefully clarify this for us and resolve some confusion if there is any. So there's a two-step process for figuring out if someone is a dependent. First, you're going to see if they're a qualifying child or a qualifying relative. And then if they do meet the test to be one of those two, you can see if they're actually can go to the next step of being a dependent. So I'll go through some of the rules here, but really the idea is not to memorize the rules from this presentation. It's just to be aware that there are multiple factors that go into making these determinations, and you just want to speak with your tax preparer to make sure that you're both going over these for the individuals in question. Or if you're preparing the return yourself, you would want to consult the instructions or IRS publication 501, or follow closely the prompts that you're given if you're doing something like Free Tax File USA or another one of the IRS sponsored online tax preparation software services. So for the qualifying child, there's a few different factors that they'll look at. The first is relationship. So it could be your son, daughter, stepchild, foster child. There's a variety of different relationships that the person can have to you. It does not necessarily have to be a biological child. The age of the person, they need to be under age 18 by the end of the tax year. Or they can be under 21, or I'm sorry, under 24 if they are at a qualifying educational institution such as a college or university. They need to not have provided over half of their own support for the year. The person in question cannot be filing a joint return. The dependent I'm referring to cannot be filing a joint return typically. So for instance, if they're married and they're trying to file with their spouse, they probably cannot go on your return as a dependent, although there are some exceptions to that. The person must have lived with you, the taxpayer, for more than half the year. That's qualifying child. There's a parallel category here, which is the qualifying relative. That person, it's similar to qualifying child, the relationship categories. So for instance, it could be your biological child, an immediate relative, or surprisingly for some folks, they could be any other person who lived with you all year as a member of your household. So I'm going over these just to just to illuminate that when we're talking about dependents, we're not always talking about, okay, this person's my son, this person's my daughter, therefore they can go on the return. But these other people, they're not my son or daughter, so they can't. That's not how it works. There's actually more people than you might think that you could have on your return as a dependent. And sometimes people we think that can go on technically couldn't. So that's why I'm just going over these rules to illuminate that. Again, with the qualifying relative, there's a residence component, so they would need to have lived with you for the entire year. They also need to make less than $5,050, and you will need to have provided more than half of the support for that person. So we can now speak about whether that person is a dependent. So if you've passed step 1 and the person in question is either a qualifying child or a qualifying relative, you can look to see if they are also able to take the final step of being classified as a dependent. So there's the United States residency component, which is they need to be either a U.S. citizen, a U.S. national, a U.S. resident alien, or a resident of Canada or Mexico. They cannot be married, and if they're a qualifying relative, they're going to be unmarried or married and not filing a joint return. Then if you are claiming this person as a dependent, you yourself cannot be a dependent on another person's tax return. So the purpose of going over these again is not for everyone to write what I just said down or to try to remember everything. The rules are all written out in the 1040 filing instructions, which I encourage you to look over if you're going to be filing yourself, or just consult with your tax preparer, whether you go to Grow Brooklyn or if Brooklyn Legal Services Corporation A assists you, or if you go to any other of the volunteer income tax assistance sites out there, or whomever you go to. These are just these should be part of the conversation you have with that preparer when you're talking about who will be on your return as a dependent. All right, we can go to the next slide. Okay, so there's something called the tiebreaker rules, which is what the IRS looks to when they're deciding who gets to claim a dependent if multiple filers independently technically are able to claim a dependent. So if there's 2 independent filers and they're both trying to claim, I'm sorry, a qualifying child. 2 independent filers trying to claim a qualifying child, one of them will win out over the other, and the IRS will look to the tiebreaker rules to decide. A parent would take priority over a non-parent. When there are 2 parents, it goes to the parent whom the child lived with the longest. If time is equally split, it would go to the parent with the higher AGI, and AGI stands for adjusted gross income. When a parent could claim the qualifying child but doesn't, the person with the highest adjusted gross income wins, but only if it is higher than that of the parent. And when no parent can claim, the person with the highest adjusted gross income could claim the qualifying child. So again, this is all for when there's multiple taxpayers who could independently potentially be claiming a qualifying child legally on a return. Only one will be able to do so, and the IRS will use these rules to decide which. So we can go to the next slide. Okay, so Mr. Weeks spoke about personally identifying information and making sure you protect that. Sometimes a taxpayer is unable to prevent another person from using their personally identifiable information, or they weren't even thinking that it would be an issue, but it does end up becoming an issue. For instance, a former partner would use the victim's social security number, name, and other information on a fraudulently prepared tax return and forge their signature. So there are measures that you can take to both proactively prevent that and to respond if it does happen to you. The first is the identity protection PIN or personal identification number. which is a 6-digit unique identifying number issued by the IRS for a taxpayer. And the next is the identity theft affidavit, which both the IRS and New York State allow you to file. So we'll go to the next slide. So for the IP PIN, which is the proactive measure that you could take, or the measure you could just continue to go forward with after a person has been a victim of identity theft. The PIN number is a 6-digit number. It goes on your tax return. The way you get this number is by going online and applying for it through the IRS's website. The paper form of 15227, you file that, then the IRS calls you to verify some information about you by asking questions like what was your adjusted gross income in 2022? You know, they'll pick a year that you have information about and you would verify yourself that way. Or you can go in person to a taxpayer assistance center and they'll verify you that way. And you'll start getting this IP PIN number in December or January of every year. And a new number will be issued each year. So if you're in this program or you're thinking about getting into it, the first number you get will not be the same number that you'll use next year. It'll change every year. And that's another way to help protect your return. The program, you're automatically enrolled in this if the IRS detects that there has been identity theft, or if you alert them to that on a previous year or any year. You'll just automatically be involved in this. So let's go to the next slide. The identity theft affidavit. So this is a form that you use to alert the IRS that you have been found to be, or that you have been the victim of identity theft. The type of situation that I was describing where another person fraudulently files a tax return in order to have a different filing status, or pull a dependent or multiple dependents onto their return fraudulently. If you become aware of that, you would file this form. You could file with the IRS. There's another one you can file with New York State. It's the 14039 with the IRS, and the 275 DTF 275 with New York State. There's a variety of ways to submit this, but the important thing is that you do get it submitted. And it's even better to work with a professional, like someone with our low-income taxpayer clinic, or if you can go to another low-income taxpayer clinic if that applies to you. But it's great to have a professional assist you, because they can sometimes help you with some of the narrative aspects and with organizing the facts and making a clean presentation of what happened. And sometimes having that objective perspective from a professional would really help your situation, especially help you submit a very powerful claim to get your matter resolved in a faster way. So we can go to the next slide. So the best practices for submitting an identity theft affidavit are, if you go forward with this, are describing your circumstances with particularity. What this is about is, instead of saying my identity was stolen and just leaving it at that, guiding the IRS to the perpetrator, if you have that person's name, if you know where they live, how they may have gotten your information, where else they may have used the information, just providing as much information about your circumstances as possible, so that the IRS, when they conduct their investigation, can do so more quickly, potentially, because you're giving them guidelines and a roadmap for where to look. The years that are affected by the tax, by the identity theft. So if you just tell them that there was a identity theft, but you don't point them to, say, 2023 or 2021, it takes them a lot longer to find what you're hoping they'll look for and discover. And sometimes they might not even find it because there wasn't enough information provided. So basically, you want to give them a bullseye to shoot for and give them a roadmap so they can really zoom in and do their investigation effectively. And you want to provide documentation. So if you received any kind of a notice that your identity has been stolen, especially if it has to do with your taxes, that would be something you would want to provide. If the IRS confirmed that your identity was stolen in connection with tax fraud, you could then also use that confirmation letter in your report to New York State or vice versa. So these are the types of things that you'd want to provide if you can. We'll go to the next slide. So things to consider when doing the ID theft affidavit. The processing time on this can be very lengthy. It can be more than a year. We've seen them go much quicker, but we've seen them take a long time as well. It just depends on how quickly they can identify the issue. And going back to the previous things I was talking about, you know, the more information you provide, the better in most circumstances. The refund that you're expecting may be frozen until they finish their identity theft review, and your account is going to be flagged for identity theft for the next 3 years. So that will actually help you out because the IRS will then be doing additional examination and processing on your tax returns going forward to ensure that it was you, in fact, who filed the return and not perpetrator of identity theft, sorry. Okay, we can go to the next slide. Okay, so a related subject here is innocent spouse relief. As the slide says, this is for obtaining relief from a tax that is not attributable to you or should not be attributable to you. There's a concept called joint and several liability. What this is in the context of taxation, when a married couple files a tax return, no matter which of the two spouses made more money, both spouses are equally liable for the tax. So that may sound strange, but again, the bottom line is basically no matter if one spouse made 100,000 and the other spouse made 15,000, if they file a joint return, they're both equally responsible for paying that tax. This relief comes in then where one of the spouses is a victim of basically being involved in the filing of a tax return that tax misconduct occurred with, and the perpetrating spouse basically misrepresented what had happened financially during the year, and it results in a larger larger tax and penalties, and other liabilities are incurred, but it's not the fault of what they would call the innocent spouse. So we can go to the next slide. Okay, so this applies to jointly filed returns. The malfeasance, or basically the misconduct, will typically be understated tax on the return, attributable to underreported income or hidden income. So if a spouse decides they're not going to report, $10,000 they got through some kind of an off the books side job they had, or something similar, and they're just going to try and hide that from the IRS. The innocent spouse, especially if they're separated from that spouse, could now start to seek relief through this innocent spouse relief program. We can go to the next slide. So when there's a packet to submit when you're applying for this, or when a taxpayer is applying for this relief. The IRS will look over the packet and they'll apply standards of review in order to figure out if the taxpayer is eligible, if they truly were an innocent spouse and they're entitled to this relief. So really what they're looking at is whether the innocent spouse had knowledge of the errors and the omissions on the tax return. They're going to use what's called the reasonable person criteria. So they try to evaluate whether the taxpayer, as a reasonable person, would have been aware of the misconduct on the tax return. If a reasonable person would have been aware that the other spouse misrepresented what was on their return, then the IRS would not grant this relief. Basically, you could think about it as if the IRS sees that the person who's applying for innocent spouse relief, if they see that that person collaborated in the tax return misconduct, the IRS would not be likely to grant that relief. However, there is an exception to that rule, so I'll get to that. We can go to the next slide. The exception, or the special considerations, basically if the innocent spouse was aware that this misconduct was happening on the tax return, but could not do anything about it because they were coerced to comply, into complying, or they were essentially forced into complying with the perpetrating spouse, then you can still get this relief. So for instance, if you're the victim of spousal abuse or domestic violence and you're forced to sign a tax return that you don't agree with, but you can't really get out of signing it for fear of further abuse, then they will look at that and they're not going to penalize you for that if that's your circumstance. So if you have documentation for that, that would be even better for you to be able to, if you can supply that with your innocent spouse relief request. So we'll go to the next slide. The way to get this relief is to file the IRS Form 8857 or New York State Form IT 285. And just like with the identity theft affidavit, if the IRS or New York State, one or the other, grants you this relief, you would want to provide that documentation to the other taxing authority if it's applicable to your situation. So for instance, if IRS responds to your application and they say, yes, you're an innocent spouse, you want to provide that confirmation to New York State if you need to file an innocent spouse claim with them. All right, we can go to the next slide. Okay, so another related topic here is audits. These are circumstances where the IRS or New York State is challenging the information that you provided on your tax return. So this is where they're challenging whether you made the income that you claimed, or whether your dependents lived with you, or whether you paid for the household expenses, or whether there's a relationship between you and the dependents. Basically, an audit is a request for further proof that you're entitled to what you claim on the tax return. We can go to the next slide. So These audits are very common. It doesn't mean that you did something wrong if you get audited. It just means that for whatever reason, the IRS or New York State has selected your return, and you now have to go through the steps of proving that your return was properly prepared and that you're entitled to these credits, deductions, and potentially refund that you're claiming. So the best way to get ready for, or the best way to respond to this is to first, if you can, be ready ahead of time. Most people probably don't expect that they will get audited, but if you've been audited in the past, you may be audited again in the future. That may make it more likely you'll be audited again in the future. So you want to just anticipate that you could be required to prove these things. It's just like if you're a business and you're claiming expenses on your tax return, um, the business would be prepared with receipts and other things in order to respond to requests for additional documentation. Um, Today, I'm not talking about businesses, I'm talking about individuals. So the corollary is with, for instance, your children, if they're going to be your dependents, you would want to get ready with documentation for where your children were living during the year. For instance, a lease agreement that has your children's names on it. That's great proof for, they lived with you and they meet that residency requirement that's needed. And the other important thing I want to talk about with this is responding to the notices right away. So the IRS in New York State, they're going to send you a notice in the mail if you are being audited. And there's typically a deadline to respond. With some of those deadlines, if you don't respond in time, it could mean that certain rights are foregone. For instance, with certain IRS audits, if too much time passes, the taxpayer foregoes his or her right to file a claim in United States tax court. So it's important, if you get one of those notices and you're not going to respond by yourself and you need help, which is totally fine. And even recommended that you come speak with someone in our office or at Grow Brooklyn or another low-income taxpayer clinic, if that applies to you, to take some action with this, because it could have serious consequences if you don't, and it could have great benefit to you if you do.
Charles, may I ask, as far as making electronic records, how long how long does the IRS have to audit me? Do I need to keep it for 1 year or 2 years? These kind of records?
Yeah, so there's the number that always people typically say is 7 years, but there's really not a number. Just try to keep them. It's really more about developing a habit of retaining your records and developing a filing system for yourself that you can use going forward. So that, if necessary, 10 years down the line, you could easily retrieve certain documents. I mean, a lot of people can't do that, and that's totally understandable. But if you develop a filing system habit, you would be more likely prepared to respond to something like that. Um, you know, so
Nope, that's helpful.
yeah.
Thank you.
Mhm. All right, so we can go to the next slide. All right, so some additional tips for filing these in connection with filing tax returns, and especially for victims of abuse, is to first, number one, file your return as soon as possible. So I spoke about the identity protection pin. Some people, especially if they just applied for it, are waiting to file their return until they get that PIN number. It's actually advisable to just go ahead and file your return right away. Yeah, if you don't have that PIN number, and then next year maybe you'll have the number sooner. because unfortunately, a lot of the way these work out is that the spouse who files first is the one who will end up prevailing in the dispute. And just you have fewer headaches if you file your return ahead of a competing person who's wrongfully trying to claim, for instance, your child as a dependent. The next is to avoid having a check sent to you if you're getting a refund. Try to have it direct deposited into your own bank account, not an account you share with someone, especially someone that you don't trust. But try to have it, try to set up, if you don't already, a bank account for yourself only. If you already have that, great, and just try to get it deposited there instead of having a check. The annual credit report is free to everybody. There's 3 of them that you can get each year, one with each of the credit reporting bureaus. This does not show your credit score. Instead, what it shows is the various types of open accounts that you have. So it'll list, for instance, your open credit card accounts. If you have credit cards that are showing up on that account, or I'm sorry, if there are credit cards that are showing up on that report that you don't recognize, that's a clue that you are the victim of identity theft, and you would need to start taking action to see how far that has spread. If it, for instance, is also touching on your tax returns, it's just a prompt to start taking action. In connection with that, we recommend services like LifeLock, which you can use to get alerts if you are, for instance, if your data was involved in like a data breach, and you'll get alerted to that, and you could take necessary action if there's anything you can do on that. And when you move around, update your address with the IRS. There's a special form for that. It'll update with Your address will update with the IRS when you file a new tax return anyway. So whether you use the form or you're filing a return, it will be updated, but you want to try to keep them updated with your new address, and do the same through United States Postal Service and have your mail sent to you, forwarded to you using your address update there. So that's pretty much it with for what I wanted to talk about today. But I do want to mention also, so we have a domestic violence clinic at Brooklyn Legal Services Corporation A. So if you are a victim of domestic violence, we assist with many different case types for that. We have a low-income taxpayer clinic. So we help taxpayers resolve their IRS and New York State tax issues. And if you're looking for a place to have your taxes prepared for free, you can go to Grow Brooklyn or one of the other volunteer income tax assistance locations. There are many of them throughout the city. So there's always a way to get your return prepared. So I think we can open it up to questions.
Yes, thank you so much, Charles. So much information. I did not know there were special circumstances for domestic violence survivors. So that was very interesting, and all this information. Thank you. I know the biggest key takeaway is, if you have questions, please reach out to us. Email us, call us, so we can address your specific tax situation. We do have a couple of questions in the chat. And I'm just gonna run them down. Tatiana asked, "What about a child credit for a 17-year-old? A 17-year-old, is a 17-year-old included or not?"
Yes. Once they were 17 and under at the end of last year, they're including the child tax credit.
Thank you. Stanislav asked, "Should I include in calculation the HRA cash and housing assistance we received during 2024?"
So really and truly, HRH, which would be public assistance, right? Correctly. Yes, that's not taxable. So you don't really have to, you don't really include your HRA payments because, and you want to get earned income credit for it in either because it's not earned income also. Earned income comes from self-employment, W-2s, 1099, miscellaneous, NECs, that sort of income.
Sure. And then they also ask, when do I have to pay taxes for the year 2024?
By April 15th, 2025.
Yes.
Taxes due should be paid. Yes, it's to be paid.
Okay. Now, Stanislav, you have some very specific questions with numbers. I am going to forward this to Jason, and at Grow Brooklyn, so they will be able to, address it directly. This is very specific. And so it's more general questions right now. But they do have a general question. As a freelancer, I use internet and mobile for my work. I also bought some equipment during 2024. Can I submit it for tax return, or I need to exclude those expenses directly?
So if they're a freelancer and they're filing for like a self-employment or they have a 1099 miscellaneous or NEC, they can include that in the expenses of once they were used for the business purposes.
Yeah. All right. Does anyone else have any questions right now? Feel free to raise your hand and I can unmute you. No. All right. I'll give you another moment. If you want to type in your question, you can. Okay. So I am not seeing any raised hands. Jason and Charles, thank you so much for sharing your knowledge and your time with us this evening. To our amazing constituents and fellow neighbors in the city, I appreciate you so much. Please, everyone, join us for part 3 of Tackling Taxes. And our sponsor will be Councilmember Crystal Hudson. And I look forward to a successful tax year. I know this is you gentlemen, this is your busy time, your Holy Grail, your Super Bowl time. So thank you for making time during this busy time of year. And I look forward to working with you all soon. And thank you everyone for joining us tonight. Hopefully we can catch the third one.
Yes, thank you very much, Kendra. Have a good evening.
You too.
Thank you, Charles.
Thank you.
Thank you.